Hey guys, it is Halloween. And I mean, I guess in fairness, this market could be a lot scarier for us as far as that goes. So let's get into it. I'm going to share my screen. Past performance is not indicative of future returns. And if you look at the markets, they are down. They've been dancing around, but mostly down about 50 to 100 basis points all morning long. And, it's really anyone's guess as to how to think about how we're going to close out the year, because we really have November. And then, as you guys know, as soon as Thanksgiving happens, that week of Thanksgiving, the market is more or less beginning its round of closing down. So you really only have about 3 more weeks to do what you're going to do this year, because trading volumes will start to really shrink aggressively as we end that last week before Thanksgiving. And every single week is going to get weaker and weaker on trading volumes. So this is really, in a lot of ways, the last hurrah of the year, and we'll see how it ends up. Let me show you what I'm seeing on FinViz. I'm a huge fan of this program. This particular element is free, and you can kind of see, let me hit the refresh just in case this isn't refreshed, but you've got a lot of red on the screen. Big cap tech selling out. I do think that you're going to have some sector rotation going on here in the end of the week. And I hate to ever make investment decisions based on these types of things, but you will want to watch out for that a bit. Of big cap tech, you really didn't have a lot of them reporting in this really wonderful way. But the crazy thing is, the rest of the market did okay. I want to show you this. I've now listened to about 150 calls at this point. And the crazy thing is, the numbers are still coming in more or less okay. I'm shocked. So as you guys know, I don't compare when I listen to the calls. I don't compare it to street estimates as my first step. My first step, I just want to see, did your revenues grow? Were you able to bring that money down through operating income into EPS? And if not, what was happening there, company by company? It's yeoman's work, but I do it and I love it. It is what it is. But I've been shocked. I was expecting this number to be so much lower, but we still have about 58% of companies doing it just fine. And then the others, the only thing I would say is the puke out of some companies, the ones that really don't have it under control, man, they really don't have it under control. It's quite ugly in some of those spots. And in some cases, it's ugly because what they've realized is, because they can't get the revenue through, because they can't get, you've got inflation pressure and they're not getting pricing, they are doubling down on either CapEx or R&D. I kind of think of them approximately the same, because some of the reasons for doing it are about the same. But that's what's happening in the puke out, is you're seeing like a true we've got a business model problem, and then CapEx and spending to try to dig out of it. So that's what it looks like. But most of the companies, because realize too that this number doesn't incorporate energy, which still needs to report in the coming weeks. And we already know that energy is going to look amazing. Like, they're definitely getting pricing through. They're definitely going to be able to bring that down. Okay, so this week's earnings, we do have BP coming out tomorrow. I think that's going to be really relevant, because I'm still trying to get better intelligence on what precisely is happening on the continent as it relates to how they're going to manage through the winter months. Winter is coming. That is the theme of Europe right now. It's ugly. And then, I probably have to add about twice the names to this, because we do have over 100 companies in the S&P reporting this week. It's not, even though big cap tech, largely speaking, mega cap tech, I guess I should call it, has reported, there's just so much still to come this week. Okay. On the economic data front, you just have to be really careful. We do have FOMC on Wednesday. Anyone's guess on what that man's going to say, like even me, because, you do still have pretty good earnings report. He's got to be seeing that. And, you've got Europe in a disaster zone, but we do have some inflation numbers starting to weaken a bit. I'm not going to say it's fully weakened, but we do have that happening. Okay, today, the other two companies I just want to talk about to show you how crazy this world is Catepiller and United Rentals. And I think these might have gotten missed in the headlines, because honestly, what they had to say to me is such a unique and intriguing macro point that it needs to be reviewed. So here's Catepiller. As you guys know, they do construction equipment. They're really big industrial equipment. let's just call it what it is. This fair and square was a great quarter. Okay. Fair and square, revenue up 20%, operating income up 45%. So they're basically pushing pricing through, and their costs aren't necessarily out of control. They are getting some benefit on supply chain. Now, do we get mad at them for getting 45% operating income? No, because that's what's actually been happening on the raw materials front. They have actually been getting some alleviation from that. That's why the numbers are working out the way they are. Net income up 43%. This number was clean. There wasn't any playing around or gamesmanship. Now, were they up a bit on earnings? Yeah, they were, but the street's not going to pile into this because, quite frankly, the guidance was, I'm going to say, modest, okay? Because poor Caterpillar's got this crazy situation where we are talking global GDP slowdown, but at the same time, like, we've got $1 trillion spending bill that's going to start hitting all of these guys in industrial equipment in 2023 and then throughout the year. So when they're looking at it, they're like, wait a second, I do have pre-orders. I do have people that have demand in my area because there is actually spending happening, even if residential has weakened a bit, even if housing has calmed down because of interest rates, you have the rest of industrial production, industrial construction, looking pretty good, which is crazy. So they guided very, very muted. If we get any alleviation on interest rates, it's going to be crazy amazing for this company. When we look at why I say they didn't cheat is if you look at all the different areas of their business, it's going fine. It's actually going really, really fine. I mean, obviously we would have anticipated energy and transportation to do well, but even construction, because of this potential bill that's coming out, is doing fine. And then here's the other thing, United Rentals, it's a little bit of a different animal from CAT in that, you know, the name says it all. It's rental, heavy industrial equipment, but they did great too. Revenue growth up 17%, income, sorry, that's a typo, up 35%, EPS up 62%. Also no cheating in this number. Wait, oh, I did want to show you this, you guys, on CAT before I switch over. Latin America, crushing it. And we've talked about the fact that this hemisphere, very different picture than the other hemisphere. And I just think that that is a testament to it. Asia Pac actually doing okay. And they're doing okay because of energy and resources being more mining equipment, that sort of thing. Because guess what? We still have a supply constraint situation going on. And if GDP, if we go into taper anywhere, if there's quantitative easing, these companies are going to do really well next year. So that's it for CAT before. Okay, back to United Rentals. Sorry, it's very exciting to see what these guys are doing. But this as well, crystal clean number, really can't even find something that was wrong in it. They were seeing approximately the same geographic mix and had exactly the same story that Catepiller had. So if you are looking for names for 2023, my suspicion is if you look in heavy industry, you actually won't see the ugliness that you might think would happen with a rising interest rate environment and residential kind of starting to slow down a bit. And with that, I'll stop the share. Any questions? It's kind of unique. It's weird.
Yes, Jaime. Can you put your forward thinking hat on? And because Elliott Wave is getting bearish,
Yeah.
what we're seeing, the 3,900 S&P is very, very important. On the way down, it was supposed to hold it, and it did not, and dropped another 10%. And now it's rallied back up 10%. So seasonality, October, November, December is a good month, good quarter, but it's already rallied 10%. So
okay, yeah.
Can you? Okay, go ahead.
No, I'm totally with you. There's wow. I am currently structured using options to be net neutral because I am really worried, not necessarily about the US economy, but I'm worried about how the traders are going to do this. And I'm worried about what people do in year end. You don't quite have the tax loss selling that you would have had in years past, unless you have, but you might have people, you might have redemptions coming in at the end of the year. And so that I think overhang is what scares me the most about the end of the year. Because if you recall last year, you had asset allocation away from equities that drove a really ugly December, January. And you still have some of that dynamic potentially happening. Now, at the same time, you've got some of the elections on this hemisphere, the US midterms, and then you've got Brazil as well, that are wild cards for what's going on. And then we still have so much geopolitical. I think that this market trades very volatile into the end of the year and starting to the beginning, until we start to see the money come in from the infrastructure bill, as well as we get a better sense for what China's going to do. That's kind of where I'm at. So that means that on bullish days, I'm going to take profits and try to find places to re-hedge my book. And on bearish days, I'm going to take some, steam out of my shorts a little bit.
Yeah, that's a good idea. I mean, it's rallied 10% and it's never rallied over 11% in the past in any fourth quarter. So
yeah, it would be crazy for it to do so, because we are still looking at, no one knows what the consumer is going to do in the fourth quarter. I mean, the purchases into the holiday season have not yet begun. October usually is kind of a weird month. So I expect CPI numbers to come out very weird, for lack of a better way to say it. I don't think you have the early holiday buying that you had last year, because quite frankly, I don't think the supply situation is what it was last year that would force people to want to buy so early. So that really means we're not going to, no one's going to have a really good call on what Christmas is going to look like, despite that they might try. Yeah. This is a really good opportunity. As per usual, I love to always give a little bit of a heads up to folks to look at Richard, our day trading specialist, who does his amazing show and does so much great educational stuff first thing in the morning, because it really is going to be his kind of market for the next 2 months. So big heads up to Richard. Take a look at Gurula.net for that.
yeah, he's cool. Okay. Do you do MGM just like in less than a minute?
Oh man, MGM is going to be MGM's going to report earnings. They had a really great quarter last quarter, got no credit for it because it does still have massive China exposure. They're really exposed to China via Macau, of course, but Singapore and Japan as well. And then I think what makes them very interesting is that they are kind of a real estate company in a lot of ways, in the sense that they still benefit from the fact that what's actually contained in a casino is a gigantic luxury retail store chain. So they basically are able to rent that space out really well. If China opens up, I think MGM is the first place you'll see it, because I think they will open up Greater China first before they really allow broad travel all over the world. So that's why I think having a position MGM is smart. Now, it's rallied aggressively since we first started talking about it. You can see the video, which is closer to 32, 31 level. But quite frankly, if you look at the valuation on this, you'll see that it still has plenty of room to go, especially if it reports a decent quarter.
Yeah. Also, California's voting on sports betting.
Yeah. I mean, Chinese girl that I am, we're a bunch of gamblers when it comes down to it. So, that is when things are going well, the casino business and the gambling business has been really good. And truth be known, it's only because of this weird COVID situation that the casinos have been doing poorly. Because if you look at the last few economic crises that we have, gambling usually does better, not worse. So if if you start to see increasing and further alleviation on COVID, the casinos are massively undervalued in general. But in fairness, the reason I'm picking MGM still is because the balance sheets look better there.
Is it a PE 5?
Yeah.
Oh my God. Technically, it looks good too. Okay.
Yeah.
Brilliant call. Thank you, man.
All right, guys, we'll keep it short today. Good luck. Be careful in the FOMC meeting if you're more of a day trader. And we'll see you next time. Bye.